Welcome back to Smart Stock Sam, the channel where we cut through the noise and follow the money. I'm going to ask you something right now. What if the biggest crash on a stock you've been watching is actually the single greatest setup you'll see all year? What if the very moment retail investors are throwing their hands up and walking away is the exact moment the most powerful institutions on the planet are quietly loading their bags? Today, we're doing a deep dive into SoFi Technologies, the stock that's been getting absolutely hammered, why CEO Anthony Noto has been calling out Wall Street for its hypocrisy, and what the next 60 days could mean for where this price is headed. Bottom or further down? Stay locked in, because the answer might surprise you. Let me paint you a picture first, and I need you to really see this. On one side, you have SoFi's internal business performance, and it is accelerating. On the other side, you have the stock price, and it is in freefall. Two lines that should be moving together are instead moving in completely opposite directions. This is what I'm calling the great divergence. To the average retail investor scrolling through their portfolio app, this looks like a catastrophe. But to the biggest hedge funds and institutional players on the planet, this kind of disconnect is the opportunity of a lifetime. We are watching a complete split between market emotion and fundamental reality unfold in real time. And the question is not whether this gap will close, it's which direction it closes, and whether you'll be positioned when it does. Now, to understand why this is happening, we have to stop reacting to headlines and start identifying the actual signals. There are three forces moving this stock right now. The first is price, and the price action is ugly. We're talking technical freefall driven by macro fear and algorithmic selling that feeds on itself. The second force is value, and this is where it gets interesting, because institutional accumulation isn't just present, it is aggressive. Firms like Citadel have increased their stake by over 234%. That's not a casual buy. That's conviction. And the third force is the catalyst. We are entering a 60-day window packed with events that could completely reprice this stock. Most people are staring at the red arrow pointing down. The smart money is laser-focused on everything else. And that red arrow? It is brutal right now. From a technical perspective, SoFi is sitting deep in strong sell territory. The stock has been trapped in a descending triangle pattern since the start of the year, and it finally broke. It snapped below the critical $18.50 support level and is now trading under $18. When a stock breaks support like that, the algorithms take over. They don't read earnings reports, they don't care about product growth, they just see a trigger and they sell. That's exactly what's happening. This is a technical breakdown, and it is creating a self-reinforcing cycle of fear. But here's what you need to understand. This is not purely a SoFi problem. There is a massive external weight dragging the entire growth sector down. The Trump administration recently signed a 10 to 15% global tariff, and that single event sent the Dow Jones plummeting 800 points in one session. Now, because SoFi is a high beta growth asset, it doesn't just catch the markets cold, it gets the full flu. High growth fintechs bleed disproportionately during macro panic events. The sell-off we're seeing is systemic, not a reflection of what's happening inside SoFi's business. That distinction matters enormously. And then came the news that really broke retail investors' spirits. Everyone was pricing in SoFi joining the S&P 500 in March. The probability was sitting around 65%. Then this week, those odds dropped to 43%. Analysts shifted their base case for inclusion all the way out to June. And just like that, a wave of retail capitulation hit. Investors who were purely in it for the index inclusion pop saw their thesis evaporate overnight, and they hit the sell button all at once. That panic selling layered on top of the technical breakdown and the macro pressure. And here we are. If we go even deeper into the technical data, things get even more interesting. The RSI is sitting at 37.4, which means we are rapidly approaching oversold conditions. The stock is trading well below both its 50-day and 200-day moving averages. Short interest has climbed to 9.22% of the float, which represents nearly 116 million shares bet against the company. That sounds terrifying on the surface, but here's what the shorts might be missing. The days to cover is sitting at just 1.98. Think about what that means. If a single catalyst hits, even one nobody is expecting right now, those 116 million short shares have less than 2 days to cover. What would a forced short squeeze do to this price? What if the catalyst was something nobody saw coming? Now, who's actually doing all this selling? Here's where it gets counterintuitive. It's not just panicked retail. We are watching a quant exodus. Algorithm-driven institutional funds like UBS Asset Management and Jane Street Group have slashed their positions by 71% and 47%, respectively. But here's the critical detail. These are machines. They execute when technical signals turn red. They are not making a judgment call on SoFi's business model. They are running a program. And there's something even more telling. Approximately 47.32% of recent volume has been happening off-exchange, in dark pools. While the public market looks like chaos, a significant volume of shares is being swapped behind the scenes. Somebody is on the other side of those trades. Ask yourself who. That somebody is what we call the smart money. While retail panics and the quant funds execute their exits, the most sophisticated investors in the world are doing the exact opposite. Citadel advisors increased their stake by 234%. That's not averaging down, that's a strategic conviction move. JPMorgan Chase now holds nearly $500 million worth of SoFi, up 37%. BlackRock added nearly 7 million shares. These institutions have rooms full of analysts, access to data the public will never see, and decades of experience navigating exactly these kinds of setups, and they are moving aggressively in the opposite direction of the algorithms. So why are they so bullish when the price is this low? It comes down to a fundamental valuation disconnect. CEO Anthony Noto has been vocal about this, calling out Wall Street directly for applying legacy bank metrics to what is clearly a fintech growth engine. If you apply a standard 44 times earnings multiple to SoFi's 40% growth rate, the fair value doesn't come out anywhere near $18. It comes out in the 30s. We're looking at a massive fintech discount that the market is currently refusing to acknowledge. And the irony is that the lower the price drops due to technical and macro pressure, the wider that gap becomes. What makes this even more compelling is that the internal business, the actual flywheel, isn't just holding steady, it is accelerating. Financial services revenue grew 88%. Loan originations grew 46%. These aren't vanity metrics. They represent real business momentum. And SoFi's member base, with an average FICO score of 745, is not the risky subprime exposure that legacy banks carry. Whether rates go up, go down, or stay flat, this high-income, credit-worthy base keeps performing. The business is winning. The ticker just hasn't caught up yet. Now here's a piece of the puzzle that most retail investors are reading completely wrong. People have noticed that CEO Anthony Noto hasn't been buying shares recently, and they're interpreting that as a lack of confidence. But here's the truth. It's a legal compliance issue. Due to short-swing profit rules tied to a contract from back in August, Noto has been legally restricted from purchasing shares. That restriction lifts on March 1st, 2026. Circle that date, because what happens the very next day, Monday, March 2nd, is a binary event that could tell you everything. Outcome A. Noto buys shares immediately. That's a signal to the entire market that the CEO sees the stock as deeply undervalued and has maximum confidence in the company's near-term trajectory. Outcome B, he doesn't buy, and I want you to really sit with this. Because in the world of high finance, silence from an insider isn't always fear. Sometimes silence signals something far more explosive. If Noto isn't buying, it could mean SoFi is currently in the middle of a deal so significant that purchasing shares would constitute trading on material non-public information. What kind of deal? Could we be looking at a major move into artificial intelligence infrastructure? A massive expansion into crypto? Or what if SoFi swallowed a legacy competitor like Lending Club entirely? Any one of those scenarios would transform this company overnight, and you'd have known to watch for it because the CEO went quiet. Beyond March 2nd, the 60-day roadmap gets even more loaded. March 20th is the S&P 500 committee review. If inclusion comes through, the price impact would be immediate and dramatic. Late April brings the first quarter earnings call, where management is already guiding for 30% growth. And on July 1st, the One Big Beautiful Bill Act takes effect, which is expected to create a significant student loan tailwind as federal lending becomes more restrictive, and that flows directly into SoFi's core business. Before I give you the final picture, I need to be clear about something important. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice, and I am not a licensed financial advisor. Investing in individual stocks carries real risk, and you should always conduct your own due diligence and consult a qualified financial professional before making any investment decisions. Past performance and analyst projections are never guarantees of future results. Markets can and do move against even the most well-researched thesis. So here is where we land. On one side of the scale, you have macro volatility, a technical breakdown, weakening S&P inclusion odds, and algorithm-driven selling. That's real and it's painful in the short term. But on the other side, you have an oversold RSI approaching a reversal zone, 116 million short shares with less than 2 days to cover. Aggressive accumulation by the most sophisticated institutions on Earth. A business delivering 88% revenue growth, and a 60-day window stacked with binary catalysts that could reprice everything. This is technical capitulation meeting fundamental acceleration. The market is offering a rare divergence, and history tends to reward those who can hold steady when everyone else is running. The only real question is this: are you following the algorithms, or are you following the smart money? If you found this breakdown valuable, do me a favor and drop your thoughts in the comments. I want to hear whether you think SoFi bottoms here or has further to fall. If you're not subscribed to Smart Stock Sam yet, hit that subscribe button so you don't miss the March 2nd update and everything that follows in this 60-day window. And if this video gave you something to think about, a like goes a long way in helping this channel reach more investors who need to hear it. Stay disciplined, stay patient, and I'll see you in the next one.